when we do these accounting adjustments, there's usually some tax effect as well. So where does this come from? So the reason is that we have different accounting rules for financial reporting and tax reporting. So we have book tax conformity that is not extremely conformed. So in Finland, we usually say that we have quite high book tax conformity, meaning that we have quite similar rules. In a country like the US, there is definitely low book tax conformity. You have definitely like a different set of tax books and a different set of financial reporting books. Everything results in that we have accounting values that differ from tax values. So consider this simple example here. Let's say that we have some building, a property, plant, and equipment item with a book value of 300. The tax base is 100. So if we go on and depreciate this asset over time in the books, we can do so with the maximum amount of 300. In the tax books, we can only deduct a maximum of 100. So we have the book value overstating the tax deductible depreciation by 200. 300 minus 100 is 200. If we look at what the accounting standards say, so they say that you need to disclose this overstatement as a deferred tax liability. So in Finland, we have a 20% tax rate. This big brown tax bear says that if you're a profitable firm, 20% of your earnings goes into my mouth. If you're a loss-making firm, I won't take any money from you. So that's quite interesting phenomena. The tax bear is rewarding loss firms and taking money away from profitable firms. So it could also be said that like the tax bear is one of the biggest shareholders of all profitable firms in Finland. But that's a side note. There's a 20% tax rate, and with our example, the deferred tax liability would be 40. Because if we take 200 times 20%, we get 40. So this is like the tax amount the firm must pay in the future that goes above the tax expense. So that's why we need to record it as a liability. This would also be the amount that the firm needs to pay in the future if the firm would sell this asset. It would be the other way around if the book value is below the tax base, then it would be a tax asset. So the other side of the balance sheet would then be used. So every time we do something with the balance sheet, asset or liability, something will happen on the income statement as well, as like a deferred tax expense or deferred tax income. This is usually what you see also on listed companies' income statements. So if we do an adjustment to this property, plant, and equipment by 50, something will happen with the deferred taxes as well. And what will happen is that the deferred tax liability will be reduced by the amount of 10. Why? Well, we take 20% out of 50 and we get 10. If we remove 10 from this original 40, we get 30. And that will be the new number on the balance sheet. So this is a short, brief explanation on why we see this tax effect when we are doing accounting adjustments.